Welcome to the rate update with Dan Frio and Nico. So we got Nico back today. This is our first ever, just basically our Table Talk Tuesdays. So we're going to start doing these every Tuesday to inform you guys everything real estate and answer any and all the questions that you have. I do this on Thursday nights, but a lot of times people, you work during the day, you're tired, you got things going on, so you might not be able to ask questions. So what happened was recently, it was just last week, I posted an update on Wednesday with the Federal Reserve, and I had about 100 people join me and continue to ask questions. So it was like, well, let's just start doing this on a daily basis. So we're going to start doing this on Tuesdays to answer any and all the questions that you have. But while we wait for people to join us, let's go over to the headlines that we're seeing right now. And I'm going to go through several things. I know there's, the reluctancy in the markets right now. People are saying, hey, housing is still going bonkers because of the lack of supply. I'm in that bandwagon too. But you're going to see here headline news from CNBC right now is supply is starting to come up between people putting their houses on the market and builders completing their properties. We're starting to see more and more supply. There's a newsletter that I posted this morning also that came out, and there was comments by a bunch of builders all over the country saying the heat index for how many people are looking to build still is basically plummeting. So what we're going to see here is higher supply, less demand, which equals what? It's bringing back down prices. Okay, so are we going to see a complete debacle in housing prices? No, because there's still huge demand for it. But the piece here, let me turn off my phone. But the piece here is we want to show is, there was no supply and tons of demand, and now we have demand kind of going back down because of higher interest rates and affordability, and then the builders and more houses coming on the market. So that's what we're seeing right now. So let's go over as we see people join us. Please ask comments as you come in. If you would, when you come in, please give us a thumbs up. Show the channel a little bit of love. If you post a question, just put a Q in front of your question so we know it's a question, not a comment. So I have Nico here. We'll answer any and all the questions that you guys have. So let's go through the economic calendar while we're waiting for people to join us. The economic calendar for today is basically the energy outlook, which I'm really not even concerned with. But we have this week, the rest of the week here. Hold on. I apologize. I thought I brought that on the board. Let's see. That might look a little bit better there. So we're going to see the economic calendar for the rest of this week. We have core CPI right here that measures inflation, crude oil inventories. This is playing a big role, and I'm going to show you here in a second in regards to why this is implementing things, and jobless claims and producer price index. So between Wednesday and Thursday, there's a lot of data coming out. All right, so we have our first visitor. Oh, home prices are going up soon. You were my doomsday sayer the other day. How you doing? This is a very, very bad sign for long-term inflation. Yes. 20 rent increases will drive inflation. Cool. Here's another thing. Let's go over when you're talking about inflation. Let's go over where the inflation numbers are. So this is a report that was just put out. And let's see the biggest pieces of the inflation triggers that we have. So we're looking here. Look at energy. If you look at energy right here across the board, you have energy in general up 32%, okay, in the last 12 months. All right, this is just the energy sector right through here. Fuel oil, gasoline, energy commodities, and energy all up about 50% or more. Then you go down through here, used cars and trucks, 35%. That's where we're seeing huge inflation numbers right there. Some of the other stuff that we watch, let's see what the index is doing right now with the MBSs. It is hugely volatile. What's happening is people are jockeying positions to see what the consumer price index is going to come out as of tomorrow, because this is the inflation number, and this is the number that the Federal Reserve is going to look at to monitor what they plan on doing. So that's that part of it. Credit card debt is up big time. Look at the numbers right here. Total household debt increased to $15.8 trillion, with credit cards making up the biggest piece of that. Credit card balances are still at 71 billion higher than where we were in Q1 2021. So there's a lot of things here, but some good news in front of all this is mortgage delinquencies. we're starting to see, or we're continuing to see those coming in line. So what does all this tell us? Basically, the supply is increasing, demand's coming down, inflation is kind of coming in check, and President Biden just had a speak on that. That is right here. If you didn't watch that, he just spoke and basically on TV saying, his concerns are inflation. Well, he should focus on energy if that's a big area that they want to concentrate on. So that's that piece of the puzzle. It's not political, so I'm not even going to go down that avenue. So let's get over the questions you guys have. So please start asking any questions that you guys have. I'm in the closing process of mortgage. Is it too late to find another lender with a lower rate? Am I bound to that one lender? Nico, take it, buddy.
Well, I would like to know where you are in the process. How long until the closing date?
So let me tell it this way, Clifford, if you're within 30 days of closing, call in now. Here's our phone number right at the bottom. If you call in now, or here's what I would prefer you do. Nico, what would you ask him to do about an LE?
What's that? Yeah, I would ask him to send me over the LE to first see if we can, make sure we can get you a great rate, beat the rate they have, so we can review it. But if you're 30 days out from closing still, we would have no issue getting you closed.
Right. And if it's an FHA loan and the appraisal is already done, we can use that appraisal. We can just transfer it over. Same thing with a conventional loan. If it's already done, we should be able to use that appraisal. So what we ask you to do is email. Let me blip up the email address. You can send it to Nico. It's right here. There's Nico's information right down below. Just send him a copy of your loan estimate that you have received from your lender, because what we don't want to do is you finding another lender at lower rates. Let's make sure we get you a lower rate. So what you'll do is just email Nico your loan estimate or your package from the lender. The one piece of the puzzle that we will need is what your credit score is. So please, in that email that you send to him or myself, please include your credit score so we know how what we're looking at with rates. So I'm gonna call you SS because I don't want to butcher your name, and I apologize about that. So SS, I expect energies to get much better in the next year. I hope you're right, and I expect it to be there as well. But when rents go up 10%, it is very painful. Yes, it is. Clifford, like you said in the bill here, my lender refused to lock in the rate. That's exactly what happened. Nico, tell them how many deals you probably are working on with extended locks and everything else. The whole bulk, basically the bulk of the pipeline.
Bulk of the pipeline right now is going to be extended locks, new builds. I mean, that's pretty much what everyone is going through right now or is purchasing. So each lender, they have their own guidelines when they can lock you in. Supposedly they have their own guidelines. But yeah, you're not bound to that lender. You're not bound to that lender. Now, let's say you're 5 days out from closing. It's not going to be a possibility.
Right. If you're 30 to 45 days out, and especially you have a USDA loan, we can use that appraisal and we can lock you in. It's simple to lock you in 60. Well, if they're refusing to lock you in, so you must not be closing real soon. Yeah, you can change anytime. What a lot of people think is you're locked into that lender. You're not, okay? But what I would ask you to do is don't bounce all over the place. Figure out, get your quotes up front. Once you start working on things, kind of let it set unless you're completely getting hosed. That's why we ask you guys to send us your loan estimates. Because if I come in and I'm like, okay, the rate that they're offering you is 5, I'm offering you 4.99, same thing. And their fees are $1,800 and mine's $1,500. Do I really expect you to make the move? Probably not. But if I come back and they're at 5.5 and I'm at 5, yes. If their fees are $8,000 and ours is $800, yes. But if it's minuscule, you probably aren't going to look to make a move in regards to that. So that'd be awesome to find out. So if you would just send us that information, Clifford, you are more than welcome. But send in your loan estimate. We'd love to help you there. Some of the programs here's what's been a lot of requests that we've had lately. Reverse mortgages. Now we do reverse mortgages and we're very good at them, but that's one section of the market we just kind of, I hate to say it, overlook. And it's probably a huge piece of the market right now. Why? Well, because if you're elderly, you have to be 62 or older, and you basically have to have half of your house paid off, if not paid off. So you have to be about 50% of your house's value to fit into this program. What it can do is it can take all your debts off of your plate. So what's happening right now, the people that are calling in, they're like, we're short every month from what we have on Social Security and pension and everything else. We're not real short, but we're short. And we don't want to have to rely on credit cards and all this other stuff to get us through the times. So how about if we get a reverse mortgage? It's pretty expensive up front. I'll say that, but we can offer you discounted fees in a lot of these areas. So that's one area that we stand out above most of the others, is there's an origination fee that in most cases we'll waive it, or we'll waive a substantial piece of that to help you out. Nico, what programs are you seeing the most requests for, or questions in regards to?
It's going to be the extended locks and the lock and shop product right now. Honestly, that is almost everything that I'm dealing with on a daily basis is extended lock and the lock and shop. Lock and shop product, it just got extended, and I think we can do it for 180 days now, which is awesome. So that's mostly what I've been doing. Been talking to people about. It's pretty much a win-win scenario with the lock and shop. So
okay, and I get it, guys out there. Refinances. Why would you refinance right now? Well, let me give you some ideas on why you might want to refinance. And let's go back to this, what I just showed you here. Where was it? Risk. Consumer debt. Okay, the first thing I want to explain to you, and I'm not trying to make light of this matter, is why do you use credit cards? Why do most people use credit cards? Well, the main reason is, let me see if I can get that out there. The main reason is you're overspending. You're spending more than you actually are making. And it's right here. Credit card balances are still at 71, or did I mess that up? 71 billion higher in Q1 than Q1 of 2021. It means people are spending a lot of money on credit cards. So before you basically get way too in debt with credit card debt, and I know your mortgage rate's probably crazy low, but why don't you think of this? Consolidate all that debt into one. You'd be amazed. And now I'm not trying to put you in any more debt. I want to make that clear. I'm not looking to put you in any more debt. I'm looking to make you a good financial steward of your monies to consolidate all that together. Here's an example. Let's say, for example, you refinance and your mortgage is 3.5%. Today's rate's 5%. Why would you refinance? Great question. Well, let's say you have $30,000 or $40,000 in credit card bills, and they're at 28% or 25% or 18%. And if you say, no, they're not that high, check your credit card statement. I can almost assure you they're probably 15, 18% minimally. Then you go to your car loans. You might owe $30,000, $40,000, $50,000 on your car payment, and that payment's $500, $600, $700 a month. Okay, that with your credit card bills of $500, $600, $700, $800 a month, you're at $1,200, $1,500, maybe $2,000 in regards to credit cards, car payments, and student loans. What if you can consolidate all those into one loan and drive down your monthly budget or your monthly debt by, let's say, $1,000 or $1,500 a month? Okay, so then what you do, you get rid of all these bills, consolidate into one, get your budgeting back in track. And then what I'd like you to do is start prepaying that mortgage, so you don't have to pay on that mortgage for 30 years. We can drive down the payoff term or time on that mortgage. If we do the math in many of these instances, we can show you how you can pay off the house quicker than you otherwise would have been, and also get rid of all your debt. The other one is the DSCR. Nico, you want to take over what this DSCR program is and how they can implement it or use it if you're an investor out there?
DSCR is debt servicing rate. Oh, why am I getting that wrong? Debt servicing. What's it called again?
Coverage ratio.
Yeah, sorry. Total brain space there.
Too many letters.
Yeah. So, okay. This product is great for investors. Pretty much what it's going to allow these investors to be able to do. Most of the time, like most of you probably know, you've been through getting pre-approved. You have to collect tax documents, pay stubs, all these items to get you qualified. Well, with the DSCR product, there's no income verification. We don't have to get into your tax returns or anything like that. Basically, what happens is once we get the appraisal done, we're going to order a rent schedule. As long as that rent schedule comes back at or below, it can be a little bit below it, that you're good to be approved for it. So it's a way to get into an investment property quick without having to qualify for it. So really the only qualifications that the lender is going to require to see is that you have a credit score of 640 and above, and have at least, I think for it's seasoned investors, we can get 15%. For a first-time investor, it'd be 20% down.
Yeah.
So again, just to recap. Go ahead.
Yeah, the best scenario for this is, if last year your tax returns are tough, and here's what I mean by that: you had a lot of rent moratoriums that your tenants might not have paid you rent. So when you do your taxes are going to look terrible. You might have taken off some time. You might have been laid off for a while. You might have had to take a pay cut or something. So your financials might not just be there for you to qualify, but you have the means to buy it. And because you're an investor now, you have other properties, you can handle it. So that's the biggest piece of this puzzle. Plus, Fannie Mae and Freddie Mac both came in about a year and a half ago, and they really raised the rates on investment properties. So many times this program is kind of in the same realm rate-wise as any other program. But again, the highlights here is you're looking to buy an investment property, period. Or you're looking to buy an investment property and you're just having a little bit of trouble qualifying. This program is very simple. Again, the recap of Nico's is, as long as the rent is sufficient enough or equal to or greater than what your mortgage payment would be, you're okay on the financial or the budget side of the equation. But you have to have good credit and the credit score to fit in that realm. You can also do this as a refinance, just so you guys know out there. But Nico, perfect on that one, buddy. Ben has a question.
Yeah, so Ben, I saw this when you emailed it. I'm actually waiting for you to email me back, buddy. I had a couple more questions on whoever else was going to be on the loan with you. So what I'll do is after this, I'll give you a call directly and we'll go from there.
Cool. Thank you. Next question is, are commercial mortgages rates a lot lower than residential? I never have done a commercial loan in my whole life, but from my understanding, most of the time it is higher. There's a pretty substantial amount of fees and costs, and you usually have to pay some points. And normally it's on some kind of adjustable rate. It's not a 30-year term, but that's just from my understanding. I've never done one because it's not like, well, if you can do residential, you can do commercial. It's a completely different dynamic. And I've never really dove into that realm of that. So if if you have any questions, please post them up here. That's what we're doing here for the day. But let me go through some of the highlights that I wanted to post today. Is the DSCR. We covered the DSCR, debt consolidation, reverses. We are getting, it's starting to trickle down, but the down payment assistance programs, Nico runs most of those for us. So Nico, can you touch base on, we'll say the good, the bad, the ugly when it comes to down payment assistance programs? We call them DPAs.
Yeah, definitely. So of course, there's hundreds of different grant programs out there. Dan and I did a video a couple of weeks back, kind of breaking the programs down. So let's just say we have about 40 different types of grant programs available. Out of all 40, Dan and I found one grant program that actually made sense, that was actually free money and didn't have really these strings attached. Because most of these grant programs that are out there, you have to pay back the money if you're refinanced within the first 5 to 7 years. You have to pay the money back if you sell within the first 5 to 7 years. It's a second lien on the property. Some of them are silent second mortgages. So there's just a lot of contingencies when using this grant program. Also, a lot of the lenders, they have to charge points up front to give you this grant. So let's say the grant's giving you 3% back to closing, help with closing costs. Well, in some cases, these lenders are charging 1 to 2 points up front just to use the product. So you're left with 1% and you have a second lien on your property. And some cases you have an extra payment. So out of all the programs that we have, Dan and I found one program that's a true grant. It's forgivable at closing. They give you 3% of the purchase price, completely forgivable at closing. Well, I tried to use that product the other day. I reached out to the lender rep and he's like, Nico, I just want to let you know our rates have gone crazy. They're really high right now. So just to use this program, they're charging to get them a rate of 6.5%. It's like a 1.5 point charge up front. So you're still only left with about maybe 2 points in a credit for a rate that is almost twice as high as the current market rate.
Right.
So again, the one product that we did find that we do love, it's kind of on hold right now until the rates can readjust. Because of the cost of it, it doesn't make sense. And real quick, let me just throw one other story in. Just 2 weeks ago, we closed on a property. One of my clients in Southern Illinois, they were trying to use the DPA product. It didn't go through. I will tell you, the DPA products, you have to fit into a small box. And if you're off just by a little, you cannot qualify sometimes. Well, this happened in this situation. We weren't able to qualify them through for the grant program. So what we did, the grant program's rate was at 6.5. So we put them into a standard FHA loan. We gave them actually a rate of 5.5. So a 1 point less than the grant program. And with that rate, we were able to give an extra $4,000 in lender credits with the higher interest rate. Whoa. So it might be a little confusing. I can explain it a little bit better. So pretty much what happens is we can almost get you the same rate the grant program's giving you, but just make it a lender credit so there's not second liens. So there's other options, I guess, is what I'm saying. Is that hopefully not confusing?
Good call. So let me explain how a lender credit works for you guys out there that are new to all of this. So let's say, for example, the going rate today is 5%. Okay, so here's how a lot of lenders come back. Well, they used to. Today's world is a little bit different because rates, the competitiveness in the environment. So let's say, for example, the rate's 5%, and that's your rate. Well, if we give you a rate at 5.25%, it's higher than what's even offered. How we used to make money years ago, pre-2006 housing bust, we would make that money. Okay, so any credits from the lender, whatever, we could take that as a commission. All right. Part of the Dodd-Frank bill said, nope, can't do that anymore. You can accept what the lender pays you as basically like a referral fee, or you can charge the client. You can't double dip. So what happens is if we raise the rate, for example, let me just use a hypothetical. Let's say the rate's 5. Let's say we can give you a 5.25. That extra 0.25% in rate might equate out to, and I'll just use simple math, 1% of the loan amount, okay, would be a credit issued back to you because of the upsell in the rate. You can use that money in any way you wanted to. Let's say it's a $400,000 loan, so that would be $4,000 credit back to you that you can use for any line item that you want. We can pay all your title fees, your legal fees, your attorney fees, your appraisal, all that out of that would relieve us from having to go to a down payment assistance program where we're at their mercy, that you have to take their higher rate, pay probably in average about 2% or 2 points on the loan. And then you have that lien on there that if you refinance or pay off the house at any point, you owe the money back. Doesn't make any sense. So we keep digging under rocks to figure out what can we offer people in regards to this. And there's not a lot of good. We don't find a lot of good in all this. So there's a lot of hype out there, down payment assistance and grants and all this other stuff. I found a grant the other day in California. It's for California specifically that'll give you 10% of the purchase price as a grant or something. Well, the average house in the area that they were publicizing this was $770,000. Okay, remember that piece of it. That's a substantial value. But to qualify it, you could not make more than $65,000. So you would probably not ever qualify for a $770,000 home if you're making 60 grand. So I'm just saying. So a lot of this is a bunch of PR work to get you to call in, so then they can just, talk you into another program. We try to be as transparent as we can here to say, guys, we've looked at this stuff for you. There are no good down payment programs out there for you, but we can come up with some alternatives that work just as well. Okay, so that's what we're trying to explain here. The next question is, do you have to pay points for a VA mortgage? In most cases, nope. We usually, honestly, in most cases, people, in the past, up until this year, I very rarely ever had people paying points. Now it is a big thing because people want to get back down to the rates that they were used to. Here's my take on this. Right now in today's market, I would not be a payer of substantially amounts of money in points. Why? Well, if you go onto YouTube and look anywhere, you're going to see that the world is ending. Okay, there's going to be a crash, there's a recession, there's a depression, the world's going to blow up, some other stuff. So what's going to happen is everybody keeps coming back and saying, and I'm agreeing with this, we're probably going to move into some slight recession. I don't know how deep it's going to be, but there's probably going to be a big pullback. We're seeing some cracking in everything right now. And I think the markets are going to do the Federal Reserve's job for them. But when the recession hits, normally what happens is you see a 1 to 1.5% reduction in mortgage rates. Now, guys, we went from about 3% to almost 6% in 90 days with mortgages. A big move fast. Okay. So it's got to stop somewhere. All right. So then once the economy starts to cool off and the Fed's like, okay, things are getting a little bit back to normal, you're probably going to see rates start to come back down. So I would not be a proponent of spending thousands and thousands and thousands of dollars right now to buy down that rate. Because let's say, for example, your payment's $2,500. If you buy down the rate, it's $2,300. So you'd save $200 a month. Okay. Well, by paying a point, let's say it costs you $4,000, $5,000, $6,000. Well, you're looking at a 2 or 3 year time frame on where you would recoup that money. So in the next 2 to 3 years, if we do not see, rates coming back down, paying the points would have worked for you. But what everybody's expecting is the economy to cool off and possibly, dive into a recession, which means rates will probably come back down a little bit. So you might be able to refinance basically by saving a lot of money than paying the points now. So hopefully that makes sense to you.
So I think this is directed at me, Dan. So this isn't American Express. It's actually got my name on
Eccentric.
There. Yeah,
what's it read up there?
It's a custom poster. So it's got American Dream, make your own luck. It's got my name over here, and then when I was born. Yeah. So we don't work for American Express. It's
American Dream, not American Express, but great call out. I like your details to that stuff. All right, Nico, you want to take this?
Just got approved for a HELOC and took out $60K to pay for medical expenses. 2.2% teaser, 6 months. Then prime rate is plus 1%, so about 3.2%. What is the prime rate? I'm on 2.875 on a 40-year after forbearance.
I'm gonna look up the prime rate right now. I used to know this, but nobody even asks it anymore. Prime rate as of this week, 4%. So let's look at this. Just got approved for a HELOC and took out $60 down, made medical expenses, 2.2% teaser, 6 months with prime plus 1. So you're going to be at 4. You're going to be at 5% at least right now. Well, when it adjusts, I'm at 2.875, 40 year after forbearance. 40 year. You were in a forbearance. I'm on 2.875. Yeah, that's a great rate, the 2.875. Oh, I see what you're saying. You got a 2.875 40-year forbearance program. Okay, you're good, and I would keep with what you have when in regards to the HELOC and the your primary loan, depending on how much you owe on your primary home. Because if that's $60,000 and you owe $60,000 on the prime plus 1 plus whatever, you might want to look at combining the two. But there's more details in here that we would need. So Bojam, if you could call in or email Nico, I'll give you Nico's information is right down below, or you can even shoot me an email. Just give us what balance you have on your primary loan, so we can figure out, the blended rate for you to see if it does make sense or not to do this. And then right here we got my man, Mr. Rogers. He joins me every podcast or every YouTube video. So thank you so much, sir. I greatly appreciate you coming in. Nico.
I am self-employed. Can I adjust my income? Can I qualify for a grant? Do you mean like next year? I'm a little, so again, here's the thing too, when you're self-employed, in most cases, you're taking a 2-year average, right? So if you adjust this year, if you're making a lot of money last year, you still might be over.
Yeah.
So in most cases, I'm going to say no. Dan?
Yeah, they won't. What happens with the loans? They take a 2-year average, and if it's going up, that's good. If it's stable, that's good. In your case, it's self-employed, so they would take a 2-year, maybe a 3-year average of your income. So you'd have to wait to do multiple years of that. So,
and then also
this might be an area where we can do a lender credit back to you to give you as much, maybe more than you would get under the down payment grant anyways. What were you going to say?
No, you're good.
Okay. Next one.
All right. Listed my house in California in June. Will arrive in Arkansas probably in July or August, and we'll be looking to buy. If I put 100 to 150K on a $250 to $300 home, should I still use a VA loan for the remaining? So here's the thing. I would want to probably take a little bit more into it. We probably would still get you a better rate with the VA loan. Yeah, I would still think so. Yeah, Dan, am I wrong on that?
The only thing I would ask is this, and here's the reason why. VA charges you a fee. So let's say, for example, if you used your VA benefits multiple times, that fee can get expensive.
Yeah.
Some cases, VA will charge you 3.3% of the loan amount as a fee on multiple uses. So because you're putting down, a substantial amount of money, what we would look at is to see if you have a VA funding fee. If you're 70% or more disabled, you normally don't have a funding fee at all. So that's, if you don't have a funding fee, I would look at that for sure. But if you used it in the past, the VA benefits, I would see what that funding fee is. And then we would also compare, based on your credit score and everything else, what package is better for you, and kind of analyze it there. So it's not, I apologize, it's not as cookie cutter as you might think, but we would analyze, this way, conventional versus VA, and then come back to you and say, which would be cheaper. Let me just explain this. Guys, all you're looking to do is get money. Please let us help you make it make sense. We want to get you the money as efficient as we can and as cheap as we can. Again, you're just getting money. So why do you want to spend a ton of money getting money? Okay. But you also have to have confidence in the company you're working with. We deal with so many people that are building their houses and doing some other things, and they're like, my lender never answers. They never get back to me all the time. Always the numbers are moving. They won't let me lock, all this other stuff. If you're having those issues, that's why we do this. Reach out to us, use our knowledge, use our lenders that we have, we have over 130 lenders. We have a lot of opportunities for you here. Also, we're your one-on-one consultant. When you're dealing with somebody here, you might be dealing with Nico. He's here all day, every day. You can text him a Saturday afternoon saying, hey, I'm looking at a house, need an updated pre-approval. He'll get it to you. How many banks, how many other lenders will do that for you? So sorry, don't do anything on Saturday.
Yeah, but David, one thing I will say is we like to, especially when we're going over two different types of quotes or two different scenarios, I really like to show you both on paper. So obviously we'd give you our advice, which would be the best to go, but I'd be able to show you, like what a conventional would look versus your VA too on two different forms. So I can explain it to you so you can see it so we can make the right choice. So that's all. Or is there a better option? And should I consider a 15-year versus a 30-year?
It depends on if you can afford that payment. It's, the payment usually the payment always on a 15-year versus a 30 is, I'll say, substantially higher. So it's how much you can afford. How much do you want to budget? How much do you want to be, do you want to be house poor, or do you want to make those payments? You can always pay more. So a lot of times I always say too, what's the difference in the rate and the payment? Okay. Because if I can get a rate at 5 on a 30-year and 4.5 or 4.75 on a 15-year, so the rate differential is hardly anything, I'll take the longer term, because once you sign on that dotted line, you have to make those minimum payments. So if you take the 30-year, you can say, well, I'll pay extra each month because I want to pay it off in 15 years. Perfect. Well, how much do I need to make as a payment? Ask us. We'll run the amortization schedule and say, okay, instead of paying $2,500, we need you to pay $2,900, and you'll pay it off in 15 years. So we can help you customize a 30-year term into a 15-year term. So that's part of that equation that we can help you there as well. Okay, so the next one.
All right. I just saw commercial condos for sale in my neighborhood. It appears they are converting commercial properties to residential units. Are loans the same as any other condos?
Let me take this if you don't mind.
Yeah, go ahead.
Those are hard, because what happens with a lot of conversions, you're going to hear, and you'll hear this, Derek, trust me, you'll hear this, first in, okay? You're going to have a really tough time being one of the first people to get into that building. Why? It's a great question. A lot of lenders, the association has to be set up. There has to be so much occupancy in the building. There can only be so many tenants in that building versus owners in that building. There's a whole slew of questions that take place in regards to that. So a lot of lenders don't want to be the first lender into that building. Let's say it's 1,000 units and they're like, we don't know where this thing's going, because the main reason being is that building, that it has to get occupied fairly quick, because your association fees that you pay into the association basically runs the building. It pays for all the utilities, all of this and all of that. So they want it, filled up as quick as they can. If they have a tough time occupying that building, they could have some major issues in regards to not being able to afford a lot of the amenities and so forth. And then if you need a VA or a USD or a VA or a FHA loan on that property, they're probably not going to be FHA approved or HUD approved for some time. So you might run into some problems there. Just checking. But if there's a local lender that's supporting that building, I would reach out to them, because they might be able to help you better than we can.
And Derek, also though, you can reach out to me too. I have a couple lenders on my list that will lend on non-warrantable condos. Good.
That's basically what he means by non-warranted. Is it's a newer property, or they just haven't passed the HUD inspections yet. Here, I'll answer this one because it's talking about tax returns. I own an S corp and can adjust my personal income. Will that help? And can you tell me more about the offerings of the grants in LA? So I'll go through there. I think we answered the thing on the income, because you're going to need at least 2 or 3 years averaged income, so that won't help. And then the LA grants I was talking about was actually probably the one you're referring to, because I saw a lot of chatter on that on the web and everything else. So I actually called the California Housing Association and asked how to apply, how to become a lender in there and so forth. But then I really started digging into the details. And again, you have to make 80%, less than 80% of the median income for that area. And when you do that, you can't make more than like 60 grand. You probably can't afford that much in LA, but it's a hard grant to get, but it is there. So, but before you dive into it, I'd love to talk to you to just see if we can help you in any other way get into buying a property, or at least positioned to get into something here in the near future.
Will they look into my net worth and my bank statements? What program are we talking about there, brother?
Yeah, when you're talking, I'll just continue on with that question. What you're going to need is basically, we need bank statements. They don't care about your net worth, but we'll need bank statements to show how much money you have for the down payment. And then that might also come into play because you own the business and a whole bunch of other things. So when you own a business, there's a lot, I won't say it's not scary to get a loan. There's more or different documentation that we have to review. But the net worth of the business is usually represented in your tax returns. So it has to be solvent, especially if you're taking money from the business and using that as your down payment. Just give you some words of wisdom. If you're buying a property, don't use your business funds, because it's much harder to qualify. Use personal funds. Trust me, you can avoid a lot of headaches by doing it that way. And that's an area where we can help you as well.
How does VA loans work as to with an inspection on a home that I'm thinking of buying? So I think what you're asking is kind of like the VA requirements for appraisal issues, or how they inspect it. The VA is going to work just like an FHA loan. So pretty much what FHA gives us, it needs to be safe, sound, and sanitary. Again, FHA, they get, this bad, people think they're bad loans, but really the only thing that's different is that appraisal issue. It's a little bit more strict. So if the property is a little bit de-stressed, it's something you're going to want to probably take a look at, because the VA won't lend on a home or FHA if the home isn't safe, sound, and sanitary. And they'll require that stuff get fixed before we close.
So let me break down the biggest caveats between the FHA and VA versus conventional appraisals. They have to do, one of the biggest things is they have to do a head and shoulder inspection of the attic. Okay. So if there's roofing issues, it's probably going to be seen in that head and shoulders piece of the equation. They also have to, there can't be any peeling of paint on the exterior of the house. There can't be any cracked windows. You have to have GFIs near all water outlets. You have to have a smoke detectors and so forth. All this stuff should be already there, and you should have no issues if you're buying the house anyways. But FHA and VA appraisals do fine tune those or dot the I's and cross the T's in those areas. That's something that your realtor should be really making you aware of. If there are any defects in the house, that we might want to look at fixing those or getting those repaired prior to doing the appraisal. But I'm still not I would still say don't shy away from FHA and VA appraisals, because they might find something wrong with the house that you didn't uncover, and it might save you tons of money in the long run. Okay, so that's that one.
All right. I assume the grants are to help low middle class get into houses. Would they penalize me for trying to take advantage of the system?
Yeah.
Yes.
They're not penalizing you. They're saying, okay, here's the income restrictions on this program. And how do we verify or validate your income? They do it with everybody. It's the same criteria. They're going to take it depends on the underwriter of the loan or the grant. They're going to use a 1 year, 2 year, or 3 year average of your tax return. So it's just guidelines. They're not trying to redline or make it harder or anything else. It's part of the guidelines. So we're just trying to explain to you, how that's not going to you changing your, how much your deductions are and all that now isn't going to change what you made last year and the previous year, but it will go forward. So if you want to make those adjustments now and then file your 2022 taxes, then we can look at it down the road. But just trying to be transparent with you.
I have an 800 plus credit and good down payment. I've been just looking. Do you recommend for me to wait? I've been just looking. Do you recommend for me to wait? I'm a bit confused with half of your guys saying buy, the other half says to wait.
Okay, so basically I get it. And that's why I do videos every day. I'm not FOMOing real estate. I want to come out. You guys can snapshot this now and whatever. I'm not hard selling people to buy houses. I'm just telling you, I've done this 33 years in this housing market. Okay, I see trends. I see all this other stuff. So why would you buy in this market versus why would you not buy in this market? The one piece of the puzzle that I can just ask is, what is your housing situation at this time? Are you in a position where you could buy? Are you going to be there 3 years at least, 4 years, 5 years, or more? Okay. And then at that point, what would you be waiting for? So I'll tell you what you would be waiting for. The assumption that house prices are going to come down. Okay. So on YouTube, there's a lot of people hyping just bad news. The world's going to crash. The world, this is that. It's 80% of that is clickbait, because they know. Just take a look at that. I've done this. I've had thumbnails where I'm like this, and I get about 1,000 clicks. I have thumbnails where I'm like this, and the world's blowing up in the background, and the house is on fire, and I'll get 10,000. So people love the bad news. They thrive on it. Okay. But what I would say is, I'll just say in my situation, if I'm moving somewhere or I'm in a location, I know I'm going to be there for a long time. I don't really care about the fluctuations in value at this time. Okay. I would be a buyer. Okay. I'm not overspending. I'm not going to bid 50, 100 grand over. But I would at least analyze in your market, how much is rent and how much would it be for a mortgage? Okay. And then analyze those. And then are you going to be there minimally 3 years or more? That'd be question 2. Do you have the money for the down payment? Can you afford that payment? And so forth. But the people out there hyping just bad news, most of them have been hyping that for a year or two, and they're going to be hyping this through, the eternity, because they're getting the clicks. What we try to do is at least guide you and educate you guys on the options that you have. And again, I'm not a proponent everybody needs their own real estate. I don't think they should.
And everyone's situation is going to be a little bit different too. So one thing we might say to one client is going to be a little bit different depending on the situation and where you're at.
And you also have, as a family, you got to discuss it and say, if you're a single person and you got the money and you want to buy, okay. But there's no one cookie cut answer. But I get where you're saying that, on YouTube, you have all these people just saying, no, 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 even realtors, which really blows my mind because that's how they make a living, but they're probably making more money on maybe YouTube than they would on the real estate side. I don't know, but I always try to ask, what is your housing situation? And then let's look at those numbers. But again, if you've been in if you plan on staying at that property 3, 4, 5, 10 years, okay, so let's say we have a 10 or 15% correction, in 2023, and then you go back to maybe normal appreciation of 3, 4, 5%. So in 3, 5 years, you'll be back to normal or appreciating above. So, you rode out the dip. But, if you wait, we don't know what tomorrow's going to bring. Will we see a dip? Don't know. Are rates going to keep going up? Don't know. So there's a lot of uncertainties out there. Derek, thank you, man. Thanks for coming on board. If you guys would, give us a thumbs up. If you would, just help the YouTube algorithms. Show us some love. If you guys would too, put a Q in front of your thing so we know it's a question that's being answered, because we don't want to just kind of come out and say whatever, if you can remember. Next one is, you want to do that one?
Yeah, sure. I'm waiting for a new build to be completed in August. Austin, Texas will be ready in August. Should I let house go or wait for prices to come down? Didn't lock in any interest rates yet. So you're just asking if you want to let the property go or purchase it to move forward. Well, again, I would want to get a little bit more info from you. Want to see where the rates are at. Let's see where that payment is at with the new rates. And it's really, what are you going to be comfortable with? Am I answering that right, Dan? Right?
Yeah. Here's Techmina. Let me throw this out. And this is the first thing I thought of, and I'll just say it out loud. You're in Austin, which is smoking hot area. It'll be ready in August. So you've probably been under contract for at least 6 months already. Even if you close now, could you sell it after the closing and make a profit? How much more are the homes now, versus when you agreed in the contract? That would be number one question. And should I let go and wait for prices to come down? I mean, that I don't see, especially if you're staying in Austin, things down there might crack. I can't say. I don't know what tomorrow's going to bring. So I don't want to go out on a ledge and say, buy it. And then a year from now, you're like, dude, I bought it for 400. Now it's worth 200. But what I'd hate to see you do is just walk away, see the builder sell that thing for 500,000 to somebody else where you might have been able to capitalize on that. So I would check and see what the going prices are, see if you closed, and worst case scenario, could you flip it and move on from there. So that's, just an idea. But do I see Austin, you watch some videos and Austin's going to, basically they'll be giving homes away soon. I still don't see that happening.
Yeah, and I have a lot of new builds right now in Texas, and I will tell you, these builders are wanting the buyers to drop out so they can sell it at a higher price. So we got to really look at that situation.
I think we just saw that one.
Thinking of a 5-year arm.
Oh, did you click that? I'm sorry. You can click
it. Thinking of a 5-year arm. This is to kind of add off of that last, comment that we had. I would call in, send me in your loan estimate to see where we're at, see where you're at right now.
So the 5-year arm, let me dive down this area with the arms. The only issue I have with arms is, in this case, 5 isn't bad. I would look at a 7-year arm. We have to basically look at your criteria, and then when I say pricing, when I price out a loan, I mean figure out your interest rate. So when I figure out your interest rate, I would compare the 30-year with the arm. Let's see what the spread is. And here's what I mean. If the 30-year rate's 5.25, and the arm rate, because of some information or credit scores or whatever, is 4.875, so there's not a big difference. I personally wouldn't be a proponent of doing an arm because I don't think there's too much risk for the reward. Now, if the spread gets to almost 1% and you're at 5 years at least, I wouldn't go under a 5-year term if I was looking at an arm. This is me personally. Then I would consider taking the arm, because now I have 5 years. During that time, is there going to be a reprieve in rates that I can lock in at the same rate on a 30-year fixed. So that's what I would truly look into. But I would see what the spread is. So, call in, let us run your rates and say, okay, here's what we have on a 30-year. Here's what we have on a 5-year. Okay. And what's the differentials? And is that enough? Would we recommend that for you? So every morning when I do the rate update, I use Mortgage News Daily. I hate to say it this way. The ARM rates that they post, they're very hard to find.
Yeah.
Because I have 150 different lenders I scan on a daily basis. Very rarely can I find that rate out there. So, but I use their model or I use their rate sheets because it's a constant. I get it every day at a specific time. It's something I can rely on at least to show you the direction and where rates are going.
Yeah, and the ARM rates are only about a quarter point better right now, and every single ARM rate has points involved to get them right now.
Okay,
just throw that
excellent.
in there. All right, don't let it go. I'm also building in Austin. Thank you, Tom.
Yeah,
that was to go.
Austin is going bonkers. So you guys down in Austin, God bless you. But we don't see that much appreciation in Illinois that you guys see in 6 months. We don't see that in 20 years. Let's see the next one. Should I buy now in New Jersey? Father of 3. If you're going to be there for at least 3 to 5 years, you're a dad, you have, this, that, a dog, a wife, kids, fish tanks, and everything else. I'm a buyer. I've always been a buyer. I like being a homeowner. I like being able to, that's my grass. That's my stuff. I can put a nail in the wall if I want to. I can hang stuff over here. I can change my carpet and all that. Some people don't like that. They're like, I just want to call up somebody and have them fix my house. I like having my house that nobody can come in, review what I'm doing and whatever else. Also, and I've said this before, let's say, for example, houses do not appreciate a penny ever. So let's say for today, you buy this house for $300,000-$400,000 grand and you pay on it for, I'll just say 30 years. Okay. So at the end of that, you have a house you own that's worth $400,000 or $500,000 that you own now. So basically it's a forced savings account, even though that house didn't appreciate a penny. Well, you've paid payments like you would in rent anyways, and you're building equity in that home. Okay. But there are some costs and other things associated with it, like maintenance and other things. I get it. But there's no one size fits all. But in your case, if you're on a solid job, you're local, you're going to be there for a long time. I don't see anything wrong with buying a house. That's my thoughts behind things. Tom's back.
New build price in Austin will not come down. In fact, it's going up due to cost of material.
Okay, but you're right. But a lot of these things are starting to be a little more flexible. We see lumber prices coming back down. They're volatile as all get out. But again, it's a window in time that we're looking at right now. Okay, what 6-8 months, a year down the road is going to be? Let's say, for example, and this is a huge example, supply chains get fixed, labor forces come back, and we start to stabilize where the economy should be. Okay. Would you be a buyer in that element? Okay. So that's what I try to look at is I don't want to see if you want to make quick money in the next 12 months or whatever, buy something other than real estate. Okay. But if you want to buy a house that you're going to live in for at least 3 to 5 years minimally, and there's a lot more to home ownership than that, but I love it. I have equity being built and it's my house. So hopefully I answered that. For flipping, check your content. Yeah. The tough thing is you hate to say it this way. What are they going to do if you flip it? I read here's the tough thing on the contracts. And let me just say this. I reviewed not a lot of them, but I've reviewed some builders contracts. Guys, you guys you need to get an attorney, because it is so skewed to the builder. Basically, they can do anything. It can take them 1 or 2 years to build a house. That's what I saw. Prices, if prices go up, we can pass those prices along to you. So basically, they can take forever to build it. They're good old time. Any price increases roll off to you. This, that, they basically have you. So once you buy their home, they're probably not going to come back and say, well, you signed this contract that you weren't going to sell it. Okay, well, I had to move. What do you want me to do? I had to move across the country for my job. Can't keep the house. So there's a lot of things there. Let's see. I'll shut up. You can answer for a while.
All right, say I lock and shop, which means I still have to submit a formal application. If I switch to another lender because the lender's terms were better, would that offend the other lender? I mean, are you saying if you were to move from another lender to us, here's what I'll tell you. If you come to me with a better deal and it's a real true deal that I can't get, I'll be the first person to tell you to move along with that deal and just stay in contact with me to make sure nothing changes. I'll review your closing disclosure at no cost to make sure nothing's changed on you, because there is a lot of that in the industry where it's like the bait and switch. They'll give you up front and then last minute they throw in fees and stuff. Not saying it's going to happen every time to you, but it could. So again, we'll be the first people to tell you. So I guess what I'm saying is, if they're a good lender, they shouldn't be offended if they want to take care of their clients.
Right. Yeah, and let's look at it this way too. We do a lot of work when it comes to this, but I'll go back to what I initially said back at the beginning of this. You're looking to get money. Okay, you're looking for money. We all have the money that you're looking for. We have to be competitive enough to get it to you at market terms. Okay, so if you come back, I would at least, if we put a lot of work into it, I would at least try to counter and say, okay, let me see if I can get a reduction in the rate or do something, or maybe shop you around again. Maybe rates went down a little bit, and we're a broker. We deal with 130 plus lenders. So maybe during that time frame, a lender came in with lower rates. They may have a special going on or something like that, so we can move it. But I would at least like the transparency and saying, hey guys, I got this offer. What do you think? Or can you guys maybe get to that where they are, because I'd like to stay with you. But you can shop around all the way up till the day you sign the papers, and there's nothing anybody can do about it. What a lot of people just don't realize is that you have the opportunity to do that. They think once you just start the application, you're stuck. And what we're trying to say is you're not stuck. Okay, you're not stuck, especially with the builders lenders who's saying, well, we can't lock you in until 2 weeks prior to closing, and at that point, there's nothing you can do. They can come back with the highest rate in town and tons of fees, and you can't do anything because you're stuck. Okay, so that's the best way I can explain that.
Oh, sorry, Dan. All right, question. Under contract inspection exposed foundation issues, possibly associated underground plumbing issues, and needs electrical upgrades and new roof. Should I ask the seller to fix or reduce? So again, if it has roofing issues, I'm going to require that it gets fixed, and depending on what they're going to reduce it down to, if that makes sense. So kind of like before, we would need a little bit more details, because again, and Dan, correct me if I'm wrong, when it comes to the roof stuff, that's where you want to definitely be prepared.
When you have an inspection done, just so you know, the inspectors are doing their best, but it's like, I don't know if you ever went through an IRS audit, they're going to find something. Okay, they're going to find something because they want to make it look like they did their job. So in this case, I'm not saying that that's what they did. God, awesome that they found these issues. But this is where your attorney gets involved. Okay, the attorneys, I hate to say it this way, they don't do a lot in this transaction if everything goes okay. Okay, where they play a huge role is in this. You have now problems. So you go to the attorney and say, figure it out for me. So if they come back and say, okay, we'll sell the house to you and we'll give you, new roofs, 15, 20 grand, electrical, if they come back and say, hey, we'll give you a $30,000 or $40,000 reduction on the price, maybe that's something you would do. But also you need to make sure that the loan product you're going through, you're not going to have appraisal issues, because if you do, then you might not be able to close anyways. So that's where we would come into play, getting with you, your realtor, and your attorney, and saying, okay, guys, we'll be okay, or we're not going to be okay. We need this resolved ASAP. But this is where you get your attorney involved, because your attorney's like an insurance policy. Hopefully you don't really need them, but they're there in the event that this happens, is the best way I can explain that.
I'm in the closing process of my newly built house. My lender refuses to lock in a rate prior to the builder letting me know of the closing date. Is this normal? I get this call 4, 5, 10 times a day. Again, it's up to the lender. They kind of make their own guidelines of when they can lock you in. Now, let me tell you, there's no national rule that tells them that they can't lock you in. That's up to their discretion. So it is normal.
That's the
Yeah,
best
don't
thing
use
I
them.
can do is if they're not, you're the boss. You're our client. So basically, I report to you. You tell me what you want. I got to do everything and anything I can to help you resolve that. If you can't, then and somebody else can do this on your behalf. Okay, I can't really be mad at you because I can't offer it. This is Janie Lynn. This is basically probably 90% of our phone calls is people asking this exact thing, same thing. So we would love to work with you, lock you into a 6-month lock that you don't have to worry. So what happens is we lock you in today. Okay. If rates go skyrocketing from here, who cares? You're locked in. If rates go down, we'll move you to a different lender as we get closer and closer to your closing date to assure you have the best rate at the time of your closing. So you have nothing to lose. Why we push the 180-day locks? There's no skin in the game. There's not a fee. If you go over 180 days, we need a check from you. Basically, probably a couple $1,000s to say, yes, I want the loan, I want locked in, and I'm not going to go anywhere else. But up to the 180-day lock frame, there's no skin in the game. There's no cost involved. So you got nothing to lose. So that's what I would suggest you do. I'm a buyer and seller. I found a house I absolutely love it in the area and I always wanted to live in. The price of the house dropped 3 times in a month. Sellers are flipping, but I want to lowball. You could try. I mean, if they've dropped it 3 times in a month, my question would be why? Why aren't others people biting on it? But yeah, you have nothing to lose to go in and lowball it. And then worst case scenario, they come to say no, but if they come in, or at least they counter, and then you know where they're at with things. So I would, if you love it, put in a low ball offer and see what happens. You never know what happens. They might just come back and say, okay, or they know you're interested, keep it on the market another month or 2, and then they might come back and say, okay, we'll re-entertain that offer. So that's that. Because of rates, I'm losing very skewed to the builder. The only power I have with a builder's contract, I can cancel. That's a great point. Thank you. I had this happen where the lender was pissed that I was still shopping and couldn't match the deal. He stopped talking to me after. Unfortunately, that's the nature of our business. We have to. Our job isn't over when you apply for the loan. Our job goes the whole duration. Plus, what we do after the fact is we monitor your loan for some, if the market drops, we'll be the first one to say, hey guys, rates are down. So we have a customer retention manager. It's like, we call it a CRM. It's a database that you go into once you close. It lets us know the rate and everything else. So then what happens is we get triggered saying, on this particular loan, current rates today are 0.5% lower than where they are. We get that alert. We'll call you up. We're not hard pressuring you. We're just saying, hey, right now the market's 0.5% lower in rates. Might be a time that you want to think about refinancing. Just letting you know. So our job starts at the application and basically never ends because we're your mortgage lender for life.
I have a rate of 3.1 when I refied a few months back. Should I let that house that I want to buy go? Again, kind of need a little bit know more about that property and where you want to go. Again, a lot of this stuff is going to be personalized and what you're comfortable with. Are you ready to buy? Are you ready for that home? Again.
So many people get, and I'll say it this way. I hate to say it this way. The rates, when back a year ago, we heard, when rates hit 4, nobody's going to buy a house. Well, they're almost 6 now. And now things are starting to slow. So we might want to sometimes, let's put the interest rate aside. Let's look at what the payment is. Is the payment something you can afford? Okay. Is it still cheaper than where rent would be? Okay. Analyze other areas instead of just everybody being, blinders on what the rate is. I've had people that were, back a couple of years ago, they were at 4.5 and they wanted 2.75 on a 30-year fixed. And I was able to get them 2.875. And they never took the loan because they wanted 2.75. So they kept the 4.5. Okay. I get it. But, don't let the rates just kind of overwhelm your whole life.
Just thank you. Awesome response because I'm a first timer. I didn't think to have an attorney step in.
Absolutely. And that's unfortunately, that's what most people are doing. Then when I'm reviewing these contracts, guys, your attorney probably would scratch the hell out of these contracts. And I would strongly suggest, I might even reach out to some attorneys in Texas and Florida and whatever, and just post that on our website and say, hey guys, this person would review your contract for, $50, or it just contract with them to use them. But they'll help you out at the get-go, because these builders know you don't have anybody. You're wild on this rate. It's like a car. You go in and you test drive that car and you're all good. And then you go to the finance manager. Then they're selling you all this protection stuff and all. And you're just like, man, that car is so nice. And you just ink the dots. Get an attorney. I can't, it's probably going to be the best $500 you'll ever spend. Right. So that's that part. So sorry.
House is fully remodeled, which is crazy. Why they dropped.
Put the offer in. The worst thing they can say is no.
Wish I would have found you sooner. I called my lender a few times regarding this, but they keep saying they haven't got a closing date from the builder yet.
It's not too late. If you would, Janie Lynn, I don't know if that's what you go by, but call in. This is Nico's, his email address down there. Just shoot him an email saying, hey, can you give me a call when you guys are done with this? At least we can answer some of the questions you have. Maybe it's too late to move. Maybe it's not too late to move. Maybe we can educate you on some things. You can go back to the builder and say, hey, I learned this. Can you do this or help me with this or whatever? So that's what we're here for. How many times can you refinance your house? As many times as you want, truly. Usually you have to, it gets difficult. It gets, it's costly. You can do it whenever you want, basically. Let me rephrase that though. Once you buy a house, you can't cash out on that house, meaning if you put a ton of money down and now it's like, 3 months later and you're like, I really want to refinance and pull money back out on the new value and all that. There's some nuances when it comes to that. So if you're looking to pull out cash or whatever, please, call us first, or at least give us, what you're looking to do so we can guide you so you're not going down the road hitting basically a brick wall at the end there.
This is about that property she's looking to buy. Sellers are delinquent on their taxes. They are a remodeling company that owns the home.
You might have a seller that just bit off too much, more than they can chew. Now they're getting stuck with inventory. So you might be able to go in and say, hey, I'll get that house off your plate. It not only gets that debt off their plate, it frees up probably some cash for them to roll into another project. So yeah, put in that offer. You have nothing to lose. As many times as you want, but why would you? Get it, Tom. We got Tom. Oh, that's why we do it. So if you guys would, please, before we leave, give us a thumbs up. That helps the algorithms get us found, okay? Share this with us. Share our thumbnail, share our post, everything else. This is what we're going to do on Tuesdays. We're going to sit here and just answer all the questions that you have. So you don't ask any questions, we'll be on here for 2 minutes. If you ask questions, we're over an hour now and we're still answering questions. That's what it's for. I also do this on Thursday nights. I know it's kind of tough, especially in the summer. It's 7 o'clock Central Standard Time that I do this. I go over one program for about the first 10, 15, 20 minutes, a program, that's working for us right now that a lot of people have interest in. And then I just answer questions. Me and Nico sit here and just answer all the questions while we're, he might be drinking a beer and I'm drinking my seltzer water. But
now, one more question, Dan, just because
yes,
so she was asking this is about that property. If they accept my offer, will taxes go up? And she's in Chicago. So I'm in Chicago too. I live in Wrigleyville. We own a condo. If you're in Chicago, your taxes are going up every year. There's no way of controlling that. But I know what you mean because they remodeled it. But what will happen is no, right, Dan? If I'm not mistaken, if the only time they would reassess it if they would add, like an add-on to the house. But no matter what, your taxes are in Chicago, they're going up every year, no matter what.
Yeah. Illinois, we have the second highest taxes behind New Jersey. Sorry, New Jersey. But yeah, the taxes here are insane. So you usually don't see a lot of reprieve there.
Last two were just me. Yeah.
Tom, I think one last one. Wait, taxes come down? No, taxes aren't coming down. We're talking real estate taxes. So, well, if you have a last ditch effort on comments, please ask now or forever hold your peace until Thursday night or next Tuesday. But I greatly want to thank you guys for coming in, watching us. I think we just had a house here. Let's go into one more question. If that is a question, the house was, and they bought it for Tuesday. Just now it's $499. Ask them. I don't know what they put into it. Just if you have a realtor, Have your realtor put in an offer? If not, if you need a realtor, you need pre-approved or whatever, call in, email Nico. We have realtors in our stable. We have a referral network there, and we can get you pre-approved or pre-qualified within probably 20 to 30 minutes tops. So that's it for today, guys. Thank you so much for our first time doing the Q&A session, Table Talk Tuesday, and I greatly appreciate it. So if you guys would, again, before you go off, please just give us a thumbs up. Subscribe if down below once this gets posted on YouTube. Subscribe, share it out. We'd love your help getting the word out to help us be more of a success on YouTube to help educate and inform everybody real estate, especially when it comes to financing. So thanks so much for watching. Without you guys here, we wouldn't be here. So thanks again. Look forward to seeing you next time. See you, Nico.
See you guys.
Take care, buddy.